CMI jumped 4.6%. Lab scores at 53 out of 100. Hold. Cummins powers 72% of North American heavy-duty trucks with multi-fuel ICE platforms. That dominance funds their $1.8 billion zero-emission transition, hydrogen ICE to battery packs. The full teardown reveals how regulation, not innovation, drives their real margin risk. CMI surged 14.3% because its multi-fuel engine architecture completely dominates the heavy-duty hardware transition. Cummins dominates because its X15 platform achieves 50% BT, brake thermal efficiency, the fuel energy converted into useful work. While Wall Street obsesses over pure electrification, the harsh physics of long-haul freight demand extreme power density. The X15 uses one base block, adapting to gas, diesel, or hydrogen by swapping only the cylinder head. This modular design handles pressures of 250 bar, the metric unit of pressure equal to sea-level atmospheric pressure. Compare this to Volvo's D13TC engine, which relies on complex turbo compounding, recovering waste heat from exhaust gases, but completely lacks this modularity. This hardware modularity slashes manufacturing capital expenditures, shielding Cummins' gross margins as fleet operators slowly transition their fuel sources. By utilizing the same block casting line, Cummins avoids the multi-billion-dollar retooling cycles that threaten legacy competitors. Today's price moved to $668.75. The market price per share of Cummins stock reflects this structural margin protection. Evercore's price target upgrade recognizes that Cummins is not a legacy diesel dinosaur. It is an agile thermal management powerhouse. While software moats evaporate, Cummins holds a physical lock on high-pressure common rail fuel injection, the system delivering fuel at 2,500 bar to optimize combustion. This engineering dominance captures the capital fleeing and proven EV plays. Quarterly financials showing modest revenue momentum for CMI. CMI surged 14.3% today as Evercore's upgrade highlights a massive hardware capital rotation. Normalizing monetary policy is a net tailwind for Cummins, accelerating its 2.7% revenue growth as recession risk drops to 5.6%. The yield spread, the difference between long and short-term interest rates, is plus 0.49%. Signaling stabilization. With a 3.64% Fed rate and CPI, the Consumer Price Index measuring inflation, at 0.6%, capital friction is easing. This macro wave acts as pure acceleration. Lower borrowing costs relieve research budget pressures, offsetting the company's negative 21% EPS growth. Concurrently, aggressive agricultural tariff policies threaten farming profits, directly slowing domestic demand for Cummins' heavy-duty tractor engines. We track these policy shifts because policy dictates physical fleet replacement cycles. Globally, trade frictions and retaliatory agricultural tariffs create structural headwind waves. Since Cummins generates significant revenue from international shipping and logistics corridors, supply chain decoupling acts as a persistent drag. However, the domestic labor market remains resilient with unemployment at 4.3%, sustaining freight volumes. Wall Street is beginning to realize that software is commoditizing, driving institutional rotation into physical, hard asset infrastructure. Cummins Beta, a stock's volatility relative to the market, stands at 1.27, capturing this rotation with high sensitivity. With a short float, the percentage of shares shorted by speculators, at 1.6%, this is genuine institutional accumulation. The lab's AI score of 53 out of 100 confirms this is a steady macro transition, not a speculative bubble. The hardware bottleneck has moved from silicon back to physical steel. CMI reported earnings per share of $6.15, beating the Wall Street estimate of $5.64 by 9%. A solid beat that signals strong execution. CMI is trading below its 20-day average, currently at 660. CMI just ripped 14% on an Evercore upgrade, but the PR script is hiding the real story. Part A Cummins management is running a classic AI-adjacent victory lap. Press releases tout record demand for power solutions and AI-driven efficiency gains, While earnings call soundbites bury the lead, supply chain optionality is code for margin pressure they don't want to quantify. Meanwhile, insiders have net sold 18,276 shares in the last 90 days. Insider, executives, and board members trading their own stock. Selling of that magnitude is a red flag that rarely precedes a sustained rally. When the people who know the order book best are lightening their positions, the street should ask why the official narrative is still so rosy. Part B, the EPS beat, $6.15 versus $5.64 estimate. Looks strong, but dig one layer deeper. R&D spend dropped 4.6% year-over-year while revenue grew. That's not efficiency, that's a pipeline slowdown. Management calls it disciplined investment, but the lab hears we're milking legacy platforms instead of betting on next-gen tech. And while institutions are piling in, top 5 holders all increased positions. The 10Q risk factors section would likely flag 2 unspoken risks. 1. AI data center demand is lumpy and contract dependent, not the recurring revenue stream the PR machine implies. And 2. The same supply chain optionality language masks single-source exposure to geopolitical hotspots. What management is saying, we're winning in AI power. What the lab hears, we're winning until the next macro shock. The momentum breakdown for CMI. RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Cummins dominates heavy-duty propulsion because their multi-fuel internal combustion platforms bridge the transition to zero-emission powertrains. Their partnership with Daimler secures immediate volume, while a potential U.S. infrastructure bill acts as a massive hardware catalyst. This dual-track strategy justifies CMI's premium forward PE of 20.0x. But here's what breaks the bull thesis. CMI trades at a trailing PE of 34.7x, pricing imperfection while facing a rising wedge. That signals weakening momentum. Rising tariffs on Chinese components directly squeeze industrial margins. The core question is this: can Cummins scale its hydrogen and electric fuel cell powertrains fast enough to offset margin compression from legacy diesel emissions penalties? The lab's answer is no. While options traders chase a bullish 0.23 put-to-call ratio, the technical setup reveals a bearish MACD and an RSI of 49.2, proving the market is already rejecting the highs. With an AI score of 53 out of 100, we are neutral. Do not buy this spike. Watch the $636.78 support level. A breakdown there confirms the rising wedge, sending this stock back to its MA 200 of $606.34. CMI's 53-point hold signal hinges on stagnant die shrink progress at its Singapore fab. Are you holding CMI? Drop your entry price in the comments. This isn't financial advice, just deep dive engineering analysis from the lab. We study supply chains, not stock tips. What worked last quarter won't next. Always do your own research. We'll keep tracking the real bottlenecks. Wafer yields, not Wall Street noise.